listen up. Japan, long seen as a quiet corner of global finance, is about to shake things up. Its bond market, usually a picture of calm, is signaling a seismic shift. This isn't just about Japan. It's about a potential ripple effect that could impact your investments, your portfolio, and the global flow of capital. For decades, Japan's super low interest rates have been a cornerstone of global finance. But that era is ending. The canary in the coal mine is singing, and its tune is telling us the macro floor is starting to crack. Pay attention, because what happens in Tokyo might not stay in Tokyo. What exactly is happening? Japan's benchmark 10-year government bond yield, known as the JGB, has been steadily climbing. For years, the Bank of Japan aggressively kept these yields near zero, a policy called yield curve control. But now, with inflation finally showing signs of life in Japan, the market is pricing in a significant shift. The consensus is growing that the Bank of Japan will continue to adjust its policies, eventually raising interest rates from their ultra-low levels. This is a profound change for a country that has battled deflation for decades. The market is anticipating this, pushing yields higher. Why does a rising Japanese bond yield matter beyond Japan's borders? It challenges one of the most enduring and massive trades in global finance, the yen carry trade. Think of it like this. For years, global investors could borrow yen at virtually no cost. They would then take that cheap yen and invest it in assets, like US treasuries or European stocks that offered much higher returns. It was a simple, profitable strategy, fueled by Japan's unique monetary policy. This trade has sent trillions of yen overseas, seeking better yields and driving demand for foreign assets. But now the cost of borrowing yen is going up. As Japanese yields rise, the interest rate difference between Japan and other major economies, like the US, shrinks. The carry in the carry trade becomes less attractive, sometimes even negative. When this happens, the incentive to keep money abroad diminishes. Japanese institutions, from pension funds to insurers, might start selling their foreign assets. They could bring that capital back home, converting it from dollars or euros back into yen. This process is called repatriation. It's not just about profit, it's about risk management. If the yen strengthens rapidly, those foreign investments become less valuable when converted back. This potential unwind is what has global markets on edge. To understand the potential impact, you need to grasp Japan's colossal footprint in global markets. Japanese institutional investors are among the largest holders of foreign assets in the world. They've poured trillions into overseas bonds, real estate, and especially equities. Think about major US stock market rallies, particularly in the tech sector. Japanese money has been a significant driver there. If these giant investors decide to reallocate even a fraction of their foreign holdings back to Japan, it could create substantial selling pressure in other markets. This isn't just theoretical. It's a real and present risk to asset prices globally, especially in markets that have benefited most from this foreign capital. So, what should you be watching? First, keep a close eye on the 10-year JGB yield. Any sustained move higher, especially past certain psychological thresholds, will accelerate these dynamics. Second, monitor the USD-JPY exchange rate. A rapidly strengthening yen is a clear signal that capital is moving back to Japan, putting pressure on those carry trade positions. Third, pay attention to any further guidance or actions from the Bank of Japan. Their policy tweaks will dictate the pace of this shift. Finally, observe global asset prices, particularly in US equities. A significant downward move, especially in sectors that have seen massive inflows, could be a direct consequence of Japanese capital repatriation. This unraveling could even challenge the dollar's recent strength, as global capital flows reorient away from US assets. This is a complex, multi-layered story with far-reaching implications. Understanding these shifts is crucial for navigating the markets ahead. For a deeper dive into the mechanics, the historical context, and the specific data points I'm tracking, head over to korra.finance. We've got the full breakdown waiting for you there. Stay sharp.